Ladies and gentlemen, what if I told you the most important signal in the precious metals market isn't gold at all, but the silent ratio sitting underneath it? The 10-1 silver to gold dynamic is flashing a warning that most investors are ignoring. History shows that when this imbalance tightens, silver doesn't just follow gold, it accelerates twice as fast. And in moments of monetary stress, that speed becomes explosive. The question is not whether gold moves, it's whether silver is about to outrun it. The idea that a simple ratio between two metals can carry macroeconomic meaning is something most investors dismiss too quickly. Yet, markets are rarely random. They're layered incentives, constraints, and historical memory. When a relationship like the 10-1 silver to gold dynamic begins to tighten or diverge from its long-term behavior, it is usually not because of sentiment alone. It is because pressure is building underneath the surface of the financial system itself. Gold has always functioned as the ultimate monetary anchor. It is no one's liability. It sits outside the banking system, and it responds primarily to confidence or lack of it in sovereign balance sheets and currency stability. Silver, by contrast, occupies a more complex position. It is both monetary and industrial, which means it is pulled into two different economic regimes at the same time. That dual nature is exactly where the structural tension begins. When the global system is stable, silver tends to behave like a secondary version of gold, moving in the same direction but with less authority. However, stability is not the default condition of a credit-based monetary order. Stability is maintained through continuous expansion, refinancing, and liquidity management. The moment that equilibrium is questioned, whether through inflationary pressure, interest rate stress, or sovereign debt concerns, the relationship between these metals begins to distort. The 10-1 framework is not a natural law, but it is a useful lens for understanding how far perception has drifted from underlying scarcity. Silver is consumed industrially at a far higher rate relative to its above-ground stock compared to gold. A significant portion of silver demand is effectively irreversible. It is embedded in electronics, energy systems, medical applications, and infrastructure. Unlike gold, which is largely accumulated and stored, silver is partially consumed. That creates a long-term supply constraint that does not reset easily. Now, layer in the financial dimension. Gold is deeply integrated into central bank reserves and institutional hedging strategies. Silver is not. That means when capital flows into precious metals as a hedge against currency debasement or systemic risk, it does not distribute evenly. It concentrates first in gold, then overflows into silver once momentum builds. This delayed transmission is critical. It creates compression in relative pricing, followed by sudden expansion when liquidity spills over. The ratio, therefore, reflects not just value comparison, but sequencing of capital flow under stress conditions. First, confidence deteriorates, then gold responds, and finally silver accelerates. That acceleration is where the distortion becomes visible. Because silver markets are smaller, less liquid, and more industrially anchored, they respond to incremental capital with disproportionate price movement. What begins as a gradual repricing in gold becomes a magnified move in silver. There is also a behavioral component that cannot be ignored. Investors tend to treat gold as the safe expression of monetary concern, while silver is treated as the leveraged version of the same thesis. This mental hierarchy reinforces itself during cycles of uncertainty. Once gold establishes a trend, silver is forced to catch up, but it rarely does so linearly. It tends to overshoot, reflecting both its scarcity and its speculative nature. Historical episodes reinforce this pattern. In previous monetary stress environments, silver has consistently outpaced gold once a critical threshold in sentiment is crossed. The initial phase is often subdued, almost misleading, as silver lags behind gold's steady advance. But once liquidity conditions shift and broader participation enters the trade, silver transitions from laggard to leader with little warning. The deeper implication is that the ratio is not merely describing price relationships. It is revealing where pressure is accumulating in the system. When one asset is structurally constrained and the other is structurally prioritized, divergence is inevitable. The more compressed the relationship becomes, the more energy is stored within it. At a certain point, that energy is released through rapid revaluation. In that sense, the 10-1 dynamic is less about equilibrium and more about tension. It reflects an imbalance between monetary trust and physical scarcity, between institutional preference and industrial necessity, and between slow-moving capital and reactive capital. When those forces align in one direction, silver does not simply follow gold. It moves with greater velocity because it is resolving multiple forms of delayed adjustment at once. Silver occupies a position in the global system that is far more complex than most investors appreciate. It is one of the few assets that simultaneously functions as a monetary instrument and a critical industrial input. That dual identity is not just a technical curiosity, it is the source of persistent structural imbalance in its valuation and behavior. As a monetary metal, silver shares historical lineage with gold. It has been used as a store of value, a medium of exchange, and a hedge against currency instability for centuries. In times of financial stress, capital tends to seek assets that exist outside the liabilities of the banking system. Silver benefits from that impulse. It carries intrinsic value, limited supply characteristics, and a long-standing role in monetary history. However, unlike gold, silver's monetary function is diluted by its industrial relevance, and that distinction changes how it behaves under pressure. On the industrial side, silver is not merely useful, it is irreplaceable in many applications. It has the highest electrical conductivity of any element, exceptional thermal properties, and critical roles in modern technologies. It is embedded in solar energy systems, semiconductors, medical equipment, water purification, and advanced electronics. What makes this important is not just demand, but the nature of that demand. A significant portion of silver usage is consumptive. Once used in industrial processes, much of it is not economically recoverable at scale. It is dispersed, embedded, or degraded in a way that removes it from immediate circulation. This creates a structural asymmetry. Gold is largely accumulated and stored. It is recycled within financial systems. Silver is partially consumed by the real economy. That means above-ground stock of silver is far more sensitive to ongoing industrial demand than gold ever is. Over time, this leads to a gradual tightening of available supply, even when headline production appears stable. The tension emerges when these two identities are activated simultaneously. In periods of monetary expansion, inflationary concern, or currency uncertainty, silver is pulled into the monetary sphere. At the same time, technological and industrial demand does not pause. In fact, it often accelerates alongside economic development and energy transition cycles. This creates a situation where silver is required in two competing domains at once, as a hedge against systemic risk and as a consumed input in physical production. Gold does not face this conflict. Its demand is overwhelmingly financial and reserve-based. Central banks accumulate it. Institutions hold it. It is not meaningfully consumed in industrial processes. This makes gold a purer expression of monetary sentiment. Silver, by contrast, is forced to split its identity between monetary signaling and physical depletion. That split is the root of its volatility. Market behavior reflects this imbalance. In early phases of financial stress, capital flows disproportionately into gold. It is larger, more liquid, and more institutionally accepted. Silver initially lags because it is not the primary reserve asset of central banks or sovereign institutions. However, as uncertainty persists and liquidity expands, attention shifts. Investors begin to look for higher beta exposure to the same underlying thesis. Silver becomes a secondary expression of the same trade. At that point, industrial constraints begin to matter more. Unlike gold, silver cannot rely on vast above-ground reserves held by central banks. Its available supply is tighter, more fragmented, and more sensitive to incremental demand shocks. When financial demand overlaps with industrial demand, competition for physical metal intensifies. That is when price discovery becomes nonlinear. There is also a feedback mechanism embedded in this structure. Rising prices incentivize short-term recycling and increased mining output, but these responses are slow and limited. Silver is often produced as a byproduct of other mining operations, which means supply cannot be ramped up independently in a straightforward manner. This delays equilibrium restoration and allows imbalances to persist longer than in more elastic commodity markets. The result is a market that behaves differently depending on which identity is dominant at a given time. When monetary forces dominate, silver tracks gold with lag sensitivity. When industrial constraints dominate, silver decouples in response to physical scarcity. When both forces are active simultaneously, the system becomes unstable in relative terms, producing rapid repricing episodes. This dual nature is what makes silver structurally different. It is not simply a smaller version of gold. It is a hybrid instrument caught between financial abstraction and physical consumption. That position creates inefficiencies in valuation, but it also creates moments of extreme opportunity when those inefficiencies correct. In the long arc of monetary history, assets that sit at the intersection of financial demand and industrial necessity tend to experience discontinuous moves. Silver belongs firmly in that category. Its behavior cannot be understood through a single lens. It is the interaction between its monetary role and its industrial depletion that drives its most significant repricing phases. Liquidity is often treated as a neutral force in markets, something that simply enables price discovery and smooth transactions. In reality, liquidity is not neutral at all. It is unevenly distributed, periodically distorted, and highly sensitive to confidence in the financial system. Nowhere is this more visible than in silver, where shifts in liquidity conditions do not just influence price, they amplify it. To understand this, one must first recognize that silver is a relatively small market compared to other major financial assets. The total investable supply is limited, the physical market is fragmented, and the futures market often dominates price discovery. This structure matters because in a thin market, incremental capital flows have disproportionate effects. When liquidity is abundant and risk appetite is high, capital spreads broadly across assets. Silver participates, but it does not lead. It follows larger monetary signals primarily from gold and broader macro conditions. However, liquidity is not static. It expands and contracts in cycles driven by monetary policy, credit creation, and market confidence. When central banks ease conditions or inject liquidity into the system, the initial impact is usually absorbed by larger, more liquid assets. Gold tends to respond first as the primary monetary hedge. Sovereign bonds adjust as discount rates shift. Equities often reprice on expectations of growth or policy support. Silver, sitting lower in the hierarchy of liquidity allocation, reacts later, but when it does, the response is disproportionately large. This delay is critical. It creates a buildup phase where silver underperforms relative to both gold and broader risk assets, even as underlying monetary conditions are becoming more supportive. During this period, positioning remains light and market participation is limited. That means when liquidity eventually finds its way into silver, there is less depth to absorb it. Price must adjust more aggressively to clear available supply. The asymmetry becomes even more pronounced during periods of financial stress. In liquidity crises, capital does not disappear uniformly. It retreats from complex leverage or less liquid assets first. This process forces rapid reallocation toward perceived safety. Initially, that safety is found in cash and high-quality sovereign instruments. Gold benefits next as a non-liability store of value. Silver, however, sits in an awkward position. It is classified as a precious metal, but it does not enjoy the same institutional depth or central bank anchoring as gold. As liquidity contracts, margin requirements rise, funding becomes tighter, and leverage positions are unwound. Silver, with a smaller market size and higher volatility profile, often experiences sharper forced liquidations. This creates downward overshooting in the early phase of stress, but the same mechanism works in reverse when liquidity conditions stabilize or reverse course. Once central banks intervene or once credit conditions begin to ease, liquidity does not flow back evenly. It returns in waves. The first wave stabilizes core funding markets. The second restores confidence in large-cap financial assets. Only after those layers are reestablished does liquidity begin to move into secondary and higher beta expressions of monetary themes. Silver belongs to that category. When this delayed inflow occurs, the impact is magnified because prior liquidation has reduced open interest and weakened positioning. There is less resistance on the way up. At the same time, industrial demand does not disappear during financial cycles. It continues to absorb physical supply. This combination, renewed investment demand layered on top of steady industrial consumption, creates a sharp imbalance. In such environments, silver does not move in a gradual, orderly fashion. It tends to gap, accelerate, and overshoot. Price discovery becomes discontinuous because the market is forced to reconcile two realities at once: improving liquidity conditions and structurally constrained physical availability. The adjustment is not smooth because the market is not deep enough to distribute new capital evenly across time. Another important factor is the reflexive behavior of participants. Rising silver prices attract momentum-driven capital, which further intensifies inflows. This feedback loop is stronger in silver than larger markets because marginal inflows represent a greater share of total liquidity. As prices rise, more participants reclassify silver from a lagging asset to a leading opportunity. That shift in perception brings in additional demand, which reinforces the move. What begins as a liquidity normalization event can therefore evolve into a liquidity amplification phase. Instead of stabilizing price, improved conditions can accelerate volatility. This is counterintuitive, but consistent with how thin dual-purpose markets behave under shifting monetary regimes. The end result is that silver's volatility is not random. It is structurally linked to the timing and distribution of liquidity itself. When liquidity is scarce, silver is disproportionately punished. When liquidity returns, it is disproportionately rewarded. The same mechanism that suppresses it in downturns is what propels it in recoveries. This dual sensitivity is what makes silver behave less like a stable commodity and more like a leveraged expression of global liquidity cycles. It does not simply respond to liquidity, it exaggerates it. History does not repeat in a mechanical sense, but it does preserve structure. Markets move in cycles shaped by liquidity, confidence, and the recurring tension between monetary expansion and monetary restraint. Within that framework, silver has consistently demonstrated a pattern that is difficult to ignore once it is properly understood. It tends to lag early in major precious metal bull phases and then outpace other assets sharply once momentum and monetary pressure converge. In the early stages of a monetary pricing cycle, the dominant force is uncertainty. Capital seeks safety, but it also seeks institutional legitimacy. Gold naturally becomes the first destination because it is deeply embedded in central bank reserves and widely recognized as a primary hedge against currency instability. During these initial phases, gold often establishes direction while silver remains comparatively subdued. This is not because silver lacks value, but because it is not the first port of call for large-scale institutional allocation. However, as the cycle develops, the nature of participation changes. What begins as defensive positioning gradually transitions into broader monetary awareness. Inflation pressures, debt accumulation, and currency debasement concerns become more widely acknowledged across market participants. At this stage, capital does not merely seek safety. It begins to seek leverage to the same underlying theme. This is where historical behavior consistently shows a shift. Silver, due to its smaller market size and dual monetary industrial character, becomes the secondary beneficiary of expanding monetary demand. The initial move in gold establishes the macro narrative, but silver becomes the expression of acceleration. Because the silver market is significantly less deep, incremental inflows have a more pronounced effect on price. This structural characteristic has been present across multiple historical cycles. In previous major precious metal expansions, silver has repeatedly underperformed in the earliest phase, sometimes for extended periods. This lag can create the illusion that silver is disconnected from the broader trend. In reality, it is absorbing positioning more slowly due to lower institutional prioritization and thinner liquidity. Once that accumulation phase matures, the transition becomes abrupt rather than gradual. What follows is a phase of rapid repricing. As confidence in the monetary trend solidifies, speculative and momentum-driven capital enters the market. At this point, silver does not merely track gold. It begins to exceed it in percentage terms. This outperformance is not linear. It often occurs in bursts where price advances accelerate sharply over relatively short time frames. The reason for this acceleration is rooted in structure. Silver markets are more sensitive to marginal demand because available supply is more constrained and less centrally held than gold. There is no equivalent of large-scale official sector stockpiling to buffer price movements. Additionally, industrial demand continues regardless of financial conditions, meaning that investment demand must compete with real-world consumption. This dual pressure creates a situation where rising prices do not simply reflect speculation. They reflect a tightening physical market. As prices begin to move, they attract further attention, which reinforces the trend. The feedback loop becomes more pronounced as more participants recognize silver, not just as a derivative of gold, but as a distinct opportunity with higher volatility and greater asymmetry. Historical episodes also show that silver tends to overshoot on the upside once momentum becomes self-reinforcing. This overshoot is a function of both liquidity concentration and behavioral dynamics. Investors often reallocate from gold into silver, seeking higher returns within the same macro theme. This rotation intensifies the move and compresses the time frame over which gains occur. Eventually, these cycles reach exhaustion. As positioning becomes crowded and monetary conditions stabilize or tighten, volatility increases in both directions. Silver, having moved further and faster, often corrects more sharply as well. This is consistent with its role as a higher beta expression of monetary sentiment. What remains important across all these historical phases is the sequence. Silver does not typically lead the initial macro signal. It follows. But once the signal is established and liquidity expands into broader participation, it becomes the dominant performer in percentage terms.